Oh, yo.
Whoa.
Oh,
Oh, we won.
oh, oh, oh,
Yeah, I'd like to greet you guys at the top of the morning. And welcome back to another episode of Wealth Wise Guru. I'm your host, John Schaff. And it is March the 3rd, 2025. The U.S. stock market is rising amid optimism over retail earnings and tariffs developments. Today, the U.S. stock market is experiencing a positive trend, which is major indexes showing gains after a volatile week. Key things impacting the market includes the impending implementation of tariffs on Canada and Mexico, which could affect trades dynamics. Investors are also focused on the up-and-coming February non-farm payroll report, expected to show moderate job growth. Retail earnings from companies like Target and Costco are under scrutiny, as they will provide insights into consumer spending. The technology sector is performing well, driven by gains in major tech stocks, while defense stocks are rallying due to geopolitical tensions surrounding Ukraine. And the up-and-coming events for this month of March 304, tariffs implementations, the new tariffs on Canada and Mexico could significantly impact trade relations market segments. 307, non-farm payrolls report. This report will provide critical insight into job growth and economic health, influencing investors' confidence. 310, retail earnings reports. Earnings from major retailers will shed light on consumer behavior and spending trends, affecting the dynamics. And what's happening in the market today? Tesla's sales decline across Scandinavia as Musk faces tests of brand. Tesla sales in Scandinavia fell sharply in February, eroding the market shares amid rising competition. This decline's significance has had its reflects potential challenges for Tesla brand loyalty in the market position. Musk embraces of high-wing politics risks turning off car buyers and sinking Tesla stocks. So he's going to have to either make a drastic decision, one way or another, to run his business and get out of politics. He's not going to be able to do both. If he can continue on this path, he's going to sink. He's going to sink his company. Elon Musk's political stance may be impacting Tesla sales, which plumbed 45% in Europe in January. This situation raises concerns about the company's future performance in investor segments. Meta, formerly Facebook, is to launch a standalone AI app in 2025, competing with OpenAI, Google. Meta plans to launch a dedicated AI app in Q2 2025 to compete with major players like OpenAI and Google. This move is crucial as it positions Meta in the rapid growing AI market. And Microsoft just handed IPO prospective Andrew a $22 billion opportunity. Microsoft potential contract with Andorra could lead to a significant opportunity for the defense tech company. This development is important as it highlights Microsoft's influence in the defense sector. And let's see, next up is Warren Buffett has sold off 950 million shares of Apple and Bank of America. Warren Buffett recent sell off of shares in Apple and Bank of America raises questions about this investment, about his investment strategy. This news is significant as it may influence market perceptions of these major companies. And that's going to do it for your morning brief. And let's look at the portfolio. As you look at my portfolio, you can see that the market continues to sell off. I'm investing this morning $19,225.34. And my portfolio is down this morning by $14.50. But I have a buying power of $6,398.56. And that comes from the position that I have in the options, in my options, which I closed out. I think it was three positions that I held. I think it was. Let's see. So one of them was Nvidia, which I closed off Nvidia at a price of $995 per contract. And let's see. And I closed off Alphabet Class A for $580. Let's see. And so since I have closed off those positions, I closed them off because the market seemed like it was going up. Actually it was down during pre-market. Then once the bell rung, it went up, and now it's gone back down again. So it's a lot of volatility in the market. So let's take a look at my portfolio and see what's going on. And first up in my options is NCLC, which is this is up by $130 now. This is Norwegian Cruise Line. Has a market value of $130. Expiration date is 3/3/33, and that's when I bought it, which is yesterday. And the expiration date is 4/11. So far today, I made $66 off of it. Again, this is Norwegian Cruise Line, and it's currently down by $2.74. The market itself is Norwegian is down by $1.54, trading at $20.40. So this stock is really not that expensive. It's not even that expensive for you to even put an option in against it. And so that's what I did. I put an option position against it, and so far I made $66 off of it. And so if you want to do an option against Norwegian Cruise Line, you hit trade option, and I would go out at least 30 days. Today is the 3rd, so I go out April the 4th. I click on buy. I click on put. Current price is $20.40 a share. And so let's look at just out of the money. Anything above the current price, since this is a put, anything above the current price is going to be into the money. Anything below the current price is going to be out of the money. So let's click on just out of the money at $20 a share. That gives us a 41.28 delta. And that gives us a very low theta of 0.196. Volatility is 55.41. Chance of profit is 34.40%. You have currently 2 contracts in place. You have another 34 that are interested in it. So if I was to implement this particular strategy, you would hit buy, and then you would place a 1 there, and here you will place 1.19. You want to make sure that say high field likelihood. The cost of this particular strategy is going to be $119.04. We're going to go out here and hit the break even. This is insignificant, this area here. From the red dot to the black dot, it's the losses. You're only paying $119, so you can only lose $119. From the black dot to the green dot is your profit. So you can actually make $1,800 off of this stock. So let's hit review. This is the P and L chart. Expected profit and losses is $500. so I can actually make $500 off of this. Worst case scenario, the stock plummets, and then I can make $1,900 off of this particular strategy. All right, since we put this in, it moves down to medium likelihood field. So what we're going to do now, we're going to go back and change this number so that this instead of being medium likelihood, we want it to be high likelihood. So we go back over here to the limiting price, which is started at 106 is the bid price, and the asking price is 132. So we're going to click that, and we're going to put in 06. And so it's still saying low likelihood, so we're going to put in 7. Because it's still saying low likelihood. So let's go with 31. So that's that's 31. Okay, let's go back up here. And instead of putting in 1, let's double it. Let's put in 2. We put in 2. That way it's the cost to $262.08. Let's go back down here and hit this. Again, this area here is insignificant. So the red dot to the black dot is your losses. And you can only lose $262.08 because that's all you're paying for it. From the black dot to the green dot, by you buying 2 contracts now instead of 1, you double your profit. Now it's $3,768. We hit review, and then we're going to implement this particular strategy. And the reason I did this because Norwegian stock is always down. It ain't worth a pile of horse. It ain't worth a pile of horse crap. So that still give me a buying power of $5,894. This is my put here. Matter of fact, I have 2 puts in the Norwegian cruise line. I have one. The one I just implemented is up. It's in the green by 224. And also this one is up by 124. And the date on this is 4/4/11. And yeah, this is a put. It's not an iron corridor. Iron corridor is different from a put. This is a put. It means that I'm expecting for this particular share to go down in value. And a iron corridor is a mixture of a stock that you're expecting to go up. It's a 4-leg strategy, and you're expecting for a part of it to go up, and then if it doesn't go up, then you got the other part, which is also a put, so you make money whether it's going up or whether it is going down. And so I have an iron corridor in Pioneer Technology. So far today it's negative 130, and I lost 310 from it. Market value is negative 475, and that's because there's a lot of volatility in the market. Pioneer going back and forth, don't know what it wants to do. Let's see, it's at $2.30 or $2.30 below current market value. Trading at 81.03. I have 107 shares of it. Value at $8,680. Total return is negative today 254. And so yeah, I made a lot of money off this stock. A couple of weeks ago, I had almost 200 shares of it. I had about 19. It was valued at about 20,000. I sold off half of it when I seen that the government was reducing its size because Palantir is a AI company that deals with the defense side of the government, dealing with AI, and so they have a lot of government contracts, and so I've sold off half of my Palantir, but still I have 107 shares of it in my portfolio, and just because the value of it has went down, that's only due to geopolitical tension and the current new president administration. Their stance on the policies and tariffs that's going to be affecting the market. Still, this is a wonderful company to have in your portfolio. Right now, it's undervalued. Do not be afraid when you see stuff like this. That just means that the market is on sale, and now you have a chance to get in on it at a bargain-based price. Where before, before you maybe it was too expensive for you to get in, and now it's only $80-some, and you get in this stock and you keep on buying until things turn around and start to go back up in value. Start to go back up in value, you can make, just all depends on how long you can hang on to it. Let's see, it's like this down this morning. A lot of times I put options in. If I continue to see a share of a company to go down, I put an option in, maybe like a put or something like that. A lot of times it's best just to buy a share in this particular company and hang on to it. Like I always say, time in the market beats trying to beat the market. And time in the market is like now you buy one share of it. See, I'm just buying one share of it. And then you can put this on autopilot, if you want to. I don't like to put that on autopilot unless the market's really, really good. And then I put it on autopilot where it'll take money and invest in it in your portfolio for you on a particular stock. So no, I'm not gonna. I like to do things on my own. Palantir, boy, I tell you, really kicking, taking a beating. So if I hadn't sold off half of mine and taken that profit, man, I would have lost it. And so just happening. I've seen that and got out of it. Well, at least I just sold half of it. Okay, let's see. It's going down. This is crypto. I haven't heard a peak at all with these so-called gurus with this crypto mess. That's why I say that's a bunch of crap. And I can't stand it. When the market is good and the market in crypto, Bitcoin, whatever you call it, it follows the market. And you get all these old crypto and Bitcoin people don't know what the heck they doing, and to my son, you got to buy and hold and all this kind of stuff. Let me tell you something. If you got this crypto in your portfolio and you ain't buying on a regular basis, the way you have like say 500 to 1,000 shares up in your portfolio, and the only thing you're doing just buying every now and then when you think it's going up, you ain't making no money. You ain't making no money. You ain't making no profit because you're not consistently buying on a regular basis. Buying a whole month foot you continually to buy no matter what it's doing, no matter what the market is doing. You continue to buy. Where the market is today is not where the market's going to be, say 6 months from now, a year from now, 2 years, 3 years, 4 years, 10 years. The name of the game is consistently buy and hold no matter what it's doing. But many of you are infatuated about what the market is doing. Oh, the market is down, so you stop buying. You stop buying, and that little old dollar crypto that you expect for it to go up in value when you ain't been adding to it. You have to continue to buy and hold in the market, no matter what it's doing today. What it's doing today is none of your business. Your main goal is to build up your portfolio. Look at my portfolio. A couple of weeks ago, my portfolio was up at $80,000. Look at it now, it's down $58,000. It took time for me to build that. Unless you got a portfolio like this, you shouldn't even be worrying about no losses. You ain't made enough money to build your portfolio up enough to be worried about some losses. You ain't made that. Nothing gain, nothing lost. Nothing gain, nothing lose. So you should be doing what you should be doing is buying and building up your portfolio. And so Tesla's continued to sell off this morning at $20.61 a share. Just buy and hold, $2.64, buy and hold. You can put what you call a put in. Let's take a look at a put. Even with a put, many of you are not going to be able to do a put. Because any movement that you do in the market is going to cost you money. And because you haven't built up your portfolio, because you have a limited amount of cash, you're not going to be able to implement some of these strategies. That's why I say you buy and hold. If you're not able to do this, just buy and hold. Now is not the time. Just buy and hold. That's what you should be doing. But if you are able to do it, let's look at a put from a month out, which will be April the 4th. Buy and put. Make sure you click on your date and you click on buy and put. Current striking point right now is $2.63, 0.95. This is a put, so anything above the striking point is going to be into the money. Anything below it is going to be out of the money. And so see how it changes. And so let's go out and look at 260 put by April 4. That gives us a 41 delta. That gives us a 45.63% chance of profit. That gives us a volume of 695. That is 695 investors that are interested in this particular strategy. Then you have on the sideline another 760 investors that are interested in this particular strategy. But they haven't pulled the trigger for some reason or another. I don't know how they come up with those numbers, how they see that. Then you have the high volatility. IV means high volatility, which is 75.12%. Mark price is 1965. Last trade is 1970. Previous close is 1216. Total return is a lot more than 1%. Okay. And then the high is 2180. Low is 1510. So if he wants to buy this particular position, you'll put one there. You'll put try 20. So that's not gonna work. So we're gonna try 19.5. 19.70. Hold on. 19.7. Oh, it's change. 90. Alright. 95. Alright. Okay, let's try 20.1. Okay. Hold on. I'm putting in too many numbers. Okay, so this particular strategy here will cost me $2,020. This is break even. This area here is insignificant. That's why you don't see no numbers. Your numbers is not moving. You're only paying $2,000, so your losses could be only $2,000. Your profit from the green, black to the green area. Worst case scenario, you can make $23,000 off of this particular strategy. You'll hit review, and then you submit. I'm not gonna submit because I'm not. It's gonna cost me $2,000. You know I have it. I have to look at it some more offline to see if I want to implement this particular strategy. So what I do if I'm up in the air about a particular strategy, I just click add to a watch list. And so I add to the watch list so I can watch it and see which way it goes. When you see it come across the screen, add to the watch list. It'll tell you what it's doing. And so if I'm satisfied with what it's doing, then I would see about implementing this particular strategy. Because see, look, it's already starting to go back up. See. So when you see numbers like that, big numbers, don't get excited. That don't mean you're gonna make $23,000. That means you have the potential of making $23,000 if the company goes bad, or the stock goes bad. That's what that means. A lot of people see that and they get, I can make $23,000. No, that's worst case scenario. Make $23,000. So your best bet is, say it's $2.66 and some change. The best bet is to buy that stock and hold on to it, and you're building up your portfolio. Like I say, the market is on sale. Eventually, Eon's going to going to come to the senses when he see he's losing billions of dollars. Right now, he's one of the richest men in the world, and so and like I said, you can't burn the candle at both ends. You burn it at both ends, you're gonna end up with nothing but a pile of goo. Because it's going to melt on both ends, all the way down to the center. And you ain't love a country in my butt. He ain't even American. He's South. He's what you call that? He's African American. Who can do it? Call us so-called black people out African American. And hell, we ain't from Africa. So he actually is from Africa. So he's African American, even though he's a light skinned persuasion. Next up was look at Goldman Sachs. Everybody's down this morning. Goldman Sachs at 29.93. My current position 1.5. Value up just under $1,000. And so, like I said, now's the time if you're interested in these particular stocks, is to be buying and loading up on them. It ain't that much cheaper, just a little bit. It's only down $29, but now's the time to be loading up on these stocks. See, this is Apple. Apple is up this morning actually by 99 cents. Value at $239. Let's see. And so this is what I do to build up my portfolio over a period of time. When I see a bargain, I just go ahead and buy it. So it gives me now 5 shares of it with a value of $13.45. Google as well. Google's trading at $167.79. Currently, I have 105 shares of it. Value of $17,681. So far, they only made $82. Total profit is $844. So if you hit trade, you hit buy. Or if you are interested and you have the money, you can hit trade and hit trade option. Or you can go out for a whole year, which is we call a leap option. You can go out to January 2026, and then you click buy. Then we're gonna hit call. Current striking point is $167.67. Anything below it, it's gonna be into the money because it's going up in value. Anything above it is gonna be out of the money because it's going up in value. So it works in the opposite direction as the put. If it's a put, then anything below the current striking point is going to be out of the money. Anything above it is going to be into the money. And so we're going to let's look at say 180 by 2026, March 2026. That gives us a 53 delta. Theta is 0.363. Chance profit is 28.46. 7 volume, 401 interest. 31.93 volatility. So if we implement this particular strategy, you will hit buy and say it will cost you $1,900. And so you'll place your 1 there, and then you'll place your 19.65. Okay, so you go back and change that maybe to 75. Then you go out here, hit your break even column. This is your stacks. This area here is insignificant. From the red dot to the black dot, or from the black dot to the red dot, is your potential profit or loss. You can only lose $19.75. That's what you pay for it. From the black dot to the green area is your profit. It goes to unlimited, and that means that it's unlimited amount of profit that you can make from this particular strategy. So if I was to implement this, it would cost me $1,975. So you're paying $1,975 for the right to buy 100 shares of Google for $180 per share by March the 20th, 2026. if the Google shares aren't $180 or higher on March the 20th, 26, then this option will expire worthless. And so you just click up and you would have this in your portfolio. I might do it later on. Right now, I don't usually do big trades online. I just show you guys the possibilities, or if you did this, what you could profit. And so not only when you do a trade like that, that gives you control over 100 shares of that particular stock. If you was to buy 100 shares of Google, just buying whole, even if you wanted to buy 100 shares, still just buying one at a time, instead of cost you $1,900, it will cost you this much. It will cost you $16,744. And so I don't have $16,000 put into a stock. And so options is a lot of time options are your best choices. And then there are some people can't even afford the option. So if you can't afford the option, that's cool too, because that was once upon a time when I started, I couldn't afford the option either. That's why over a period of time, you build up your portfolio. And you build up by clicking buy, and you buy one share of this particular company that you are interested in. It doesn't have to be Google. Google is really expensive. It can be Home Depot. Well, Home Depot is expensive, even more expensive than Google. All what you can do is, since we have using Robinhood, you can use fractional shares. You can do it. You can go up and instead of hitting shares, you can hit dollar amount and put yourself $25 in there. You don't have to pay the whole price. Put yourself $25 in there, and each time that share goes up, that $25 goes up as well. You do that on a regular basis, and your portfolio can grow as well like that. It's just growing at a slower pace. And if you do enough of those $25, then you'll be able to own a whole share of that particular company. Netflix is another one. Netflix is $955.56 a share. The value of it is $17.76. It's up by 1.76% today. I have 0.133 shares of it. Market value $127. So I don't want to put no $955 in Netflix, even though it is a very, very valuable company. So you can hit trade, hit buy, and it's still in the option. It's still in the fractional shares. You can just put $50 or $100. You just put that in there. Or you can put $5 in there. Just also depends on what you have available in your portfolio. Nobody knows your financial situation except you. So just because the market is some of these stocks are really high, doesn't mean that you cannot afford to get in them. And like I say, you just keep on buying and keep building up your portfolio. No matter what the market is doing today, the market is going to do what it do. And actually what it's doing today, really is none of your business. Your main goal is to build up your portfolio. And what it does at $111 and 88 cents a share. I have 124 shares of it. Market value just under $14,000. We hit trade trade buy. And we're going to switch back over to shares. We're going to be buying one share of NVIDIA this morning. And so it gives us 125 shares now. And the value of it now is 14,000. Even though it's losing money still today, it's going to turn around. And so if you are interested in placing options on NVIDIA, you hit trade option. You go out and do a leap. I only do leap in options. You can do 30 days. You can do 60 days. You can do 90 days. Do not do day-to-day or weekly or bi-weekly. You don't give the stock a chance to grow when you do that. And that is the best way to start losing money, by doing that. So you want to do just a leap this year to year. And just because you do a leap this year to year, it doesn't mean you need to hold on to it for that long period of time. If you feel like that particular position has made enough of profit off of it, and you had maybe 30, 40, 50, 56%, and you got another 50% to go, or you got 20% or 25% to go, you might want to take your profit and go with it. Cause if you try to stick it out until the expiration date, it might start to go back down, and you might lose the gain that you have made. So, but that's your call. And so with this leap, I would go March the 20th, 2026, and I would hit buy and call, and as you can see, it turned red. And anything above current striking point is 112. It's going to be out of the money. Anything below is going to be into the money. And let's go. We look at this same 120. 120 give us a 58 delta. Has a chance of profit 2641. Volume is 1,124. 4,000 are interested in it. Volatility 52%. It's on my watch list. If I was to buy this, this will cost me, as you can see, $22.85. Let's go ahead and hit the break even. This is your non-significant area, and this is your losses on the black to the red. You're only paying $22.75, and that's what you can lose. You lose what you pay. On the black to the green area is your profit. And yes, this is your profit. Unlimited can be anything. It can be 5,000, 6,000, 10,000. And this is when you see a leap and it's doing this here, this is not your worst case scenario. As long as you are invested into a good company. I have made plenty of money doing this, doing leaps. And like I said, sometimes that this particular strategy reaches goal way before expiration date. So it's not necessary that you hold a particular strategy like this until its expiration date. Another thing you can do is you can hit trade. You can hit trade options, and you can go out 30 days. You can go out to April 4th. You can hit buy. Well, let's see. Hold on. Let's see. Hit trade. Hit buy. Keep going back to the same thing. We're going to hit NVIDIA. We're going to hit trade. We're going to hit buy. Okay. Trade option. We want to go out to April 4th Okay. Okay. Maybe the 4. Current striking points is 112.11. Let's hit since it's just 30 days out. Let's hit the plus sign over here, which is $7.40. $7.40. It's 100 shares and it's 100 options in each share. So $7.40 means 700 and wait a minute, hold on. Okay, I see what I'm doing wrong. I knew I was doing something wrong. We're gonna hit we're gonna hit sell and call for April the 4th. Share price is 112. We're gonna look at this, and it gives us the 48 delta. Theta 14, chance of profit 70%, volume is 1556, open interest 1884, high by 2 64%. So we're gonna hit add over here in this column. We're gonna hit the plus sign. We're telling the system that we're gonna be adding to it. So this being this $715. I mean $7.15 what it's saying, but actually 715 because it's multiplied of 100 because each option has 100 shares in it. When you buy just one share, you just buy one share, and that one share is maybe $7, and that's all you pay for that one share. But when you're doing the options, it's multiplied by 100, so $7.20 means 725. And so we're gonna go back up to the top, and we're gonna hit buy call. We're gonna add to this position. Look at it. That's delta 47. Theta 0.387. Chance of profit 28.48%. Volume of 319. Open interest of 1,185. Volatility 63. So we add that to it, and we'll go back to the top, and then we're gonna hit sell, and we're gonna hit put. We're gonna go below the current striking point, which is 111. We can look at it. 42 delta, 41 delta. Chance of profit 64%. Open volume 2,000. Open interest 27. And volatility 65. Close that out. We hit plus sign. $7.35, which is 735. We're gonna go back to the top. We're gonna click on buy. We're going to go one leg down, which is 105, 33 delta, chance of profit 30%, volume of 572, open interest of 8,152, volatility 67. Then we close that out. Then we hit that. This is what you call an iron quarter door. 30 days. Your profit can be $230. You immediately get a credit of $2.30 just by implementing this particular strategy. This is you're only paying $270. You're only paying $270. Let's see. Yeah. So your loss is gonna be $270 if it was to lose. This area is insignificant. 4-leg strategy called iron quarter door from black dot to green dot. It's your profit. That's one profit. This area here is insignificant. Don't even worry about it. This is your other leg over here, which is 230. So that's 230 from that leg. And 235 from that leg. So that gives you a nice little profit in 30 days. So we close that out. And this is what you call an iron corridor. And you can do this on any company that you have in your portfolio. And it's an excellent way to build up a small account without having to pay so much money. If you want to double that, instead of putting a 1 there, you can put 2, 3, 4, 5, whatever you want to put. Now the profit is 510, and still 2 something. And so this is the max loss, 494. This area is insignificant. So the black dot, green dot is 506 for that leg. This area is insignificant. On the green dot, this is your profit for this leg. So you would go here, put in your limiting price, which is over here. You want to make sure it goes up to say high likelihood. So we're going to put in 2, let's say 255. Let's put in 255, see what that looks like. Okay, that's going to be too high, so we're going to go 245. High likelihood field. You hit review, and you swipe up, and you implement this particular strategy where it's been partially filled. I had to put okay, now it's been filled. I had to put $1,000 collateral with that. And so that gives me still buying power of $4,000. And here it is right here. Iron corridor. And it's up, it's at 500, 520, and you just watch it. And it tells you right now it's down by 31 cents. And so you go around here and watch it, and this is your numbers. Your numbers here, hopefully these numbers turn around and they'll start going back up. If it doesn't, this is your simulated returns of it. Maximum profit be $500. Right now it's down 27, so we have a whole month to watch this particular strategy to see how it pans out. If it started to go against you and you start to lose money, you can just close it. You hit close. You can hit close, and it's just your estimated cost if you was to close it out. Or you could okay, you can't roll this position just yet. You can hit close or you can hit open, and it all just depends on which one is paying you the most money. It's one you hit. If you hit open, then you'll get an estimated credit of $249 for this particular position. But the iron corridor is an excellent way to take a small account and build it up without it having to cost you a whole lot of money. And you can place as many iron corridors as you want in different companies. You do not have to necessarily own 100 shares of that company to place an iron corridor. You can do it in Tesla. You can do it in American Airlines. You can do it in NOC, Northrop Grumman, which is military side of stocks, military stocks. It's also a wonderful stock to have in your portfolio, but it's down this morning at 66. No, it's up actually at 60 cents, but it's very expensive. Northrop Grumman. But you can place an iron corridor in any one of these stocks. And you can do an iron corridor as much as you want, as long as you have the funds to cover it. Same thing with Metal, Facebook. You can do an iron corridor in it as well. And like I said, it's an excellent way to build up your portfolio. So let me get through this. Time has really been forespent. When I'm teaching these classes, time getting really long. I'm gonna show you guys another advanced method of trading, but I know a lot of you is not going to be able to get into this, and neither am I. So don't feel bad about not able to do this. Just want to point it out to you. Index options. Are this is the big boy game. S&P Y 500 index. Let's look at that. Trading at $5,754. So far, it's down this morning. Open volume of $5,811. Total today's highs are 5,811.98. Today's low is 5,732.59. And then you got previous close. You got the 52 weeks high, 52 weeks low. So you'll hit trade. Then you'll select your date. We'll go out. Let's try to go out. It's like 30 days. And you can trade on any day, as you can see. So we hit April 4th, 2026. We hit buy and call. And we're expecting for this position to go up in value in 30 days. So we're going to click on that. Gives you a 53 delta, chance of profit 34, 47, volume of 18, 2 open interest, volatility 20. You can either add to the watch list and just watch it. If you buy it, you put a 1 there. And then here you put your limiting price in, starting at 145, 60, 140. Let's see. This is just a demonstration only because I can't afford this either. Let's see. 145. 60. He is doing it. More. Okay. This will cost you $14,580. Yeah, like I said, this is a big boy game. You click on break even. This is your insignificant area, and this is your losses. You're gonna lose what you pay for it, which is $14,000. And this is your gain, the black dot from the green area. And this is the big boy game. It's the black dot to the green area. This is the big boy game. And I don't have enough in my portfolio to be playing these games either. But you hit review and see I had to deposit more funds. So this is, see, I need $12,000 just to implement this particular strategy. And so, like I said, this is the big boy game. And again, it's called the index options. You got the index options, and then you got the futures. Your futures is also another big boy game. Futures you had to be approved to do all this stuff. Or whether you're doing options, you do options, that's your first approval, and then you get into features, and then you can do index as well. Features is you have to have your margin. You have to have the margin to cover features. Just say this is a micro gold feature. You have to have a margin 1375. It means that you had to have 1375 available in your portfolio. So you'll hit trade and you'll hit buy. You'll put your one in for one quantity, and it'll cost you $13.76 in order to implement this particular strategy. The thing about futures is another term of day trading. Once you implement this, you got to continue to watch it because everything moves at a fast pace. So you can make fast money and you can lose fast money. So it works just the opposite if you start to lose. Name of the game is to get in and get out and watch what you're doing if you're going to be doing futures. And so that's going to do it for today's video. Thank you guys for watching and tuning in. And if there's nothing else significantly happens today, then I'll see you guys again on Wednesday morning at the opening of the bell. Until then, may all your trades be a good one. Have a good, blessed day, whether you go to and fro from work or school. See you guys again Wednesday morning.